At 3 in the morning, while you're asleep, a quiet machine is moving your money, not the cash in your wallet, not the balance in your app. Something deeper, something that decides who gets rich, who survives a crisis, and who quietly disappears under debt. Most people think banks are simple. You deposit money, they lend it out, they make a little profit. In between, that story is neat, comforting, and mostly wrong. Here's the uncomfortable truth. Almost every dollar used was created by a private bank, not the government, not the central bank, a private institution, typing numbers into existence. And that changes everything. Because once you see how private and public banks actually work side by side, you start to notice something strange. The risks are social, the profits are private, and the rules are written to make that feel normal. Let's start with why this matters right now. Household debt is near record highs. Governments are drowning in deficits. Interest rates have whiplashed from zero to painful in just a few years, and every time the system shakes, the same thing happens. Public institutions step in, private banks step out intact, sometimes stronger than before. We're told this is stability. We're told this is protection. We're told this is just how finance works, but that story hides a deeper mechanism. To understand it, you have to unlearn one idea first. Banks do not lend out deposits. That's the myth you were taught, that your savings are being passed to someone else as a loan. In reality, when a private bank approves a loan, it creates new money on the spot, not from a vault, not from other customers, from nothing but a balance sheet entry you signed for. A mortgage. The bank types numbers into your account. New money now exists at the same time. You owe the bank that money plus interest. The bank didn't give up anything. It just manufactured a financial asset and a matching debt. That's how most money enters the economy. Now, pause there, because that one fact quietly separates private banks from public ones. Private banks create money for profit. Public institutions create money for policy. Private banks create money when it benefits them. Public banks, in theory, create money when it benefits the economy. And those incentives point in opposite directions. Private banks are not rewarded for stability. They're rewarded for growth, more loans, more leverage, more interest income, which means more money creation during booms and more collapses during busts. Public banks and central banks are supposed to counter that cycle, to lean against bubbles, to stabilize crashes. But here's where the irony starts to creep in. When private banks expand too far, things break. Public institutions rush in with liquidity, bailouts, and emergency support. Losses get absorbed by the public. The system gets reset. The same incentives remain. It's like a casino where players keep their winnings, but the house covers their losses. We don't call that a rigged game. We call it too big to fail. And we're just getting started. Because once you see who controls money creation, who takes the risks, and who gets rescued, the line between private and public starts to blur in a very uncomfortable way. Most people think the central bank is the boss, the final authority, the entity that controls money. In reality, central banks mostly react to what private banks already did. Private banks decide when to create money by issuing loans, mortgages, business credit, consumer debt. The central bank doesn't start that process, it follows it. When private lending explodes, the money supply explodes. When lending freezes, the economy suffocates. Central banks step in after the fact. They lower rates, they inject liquidity, they buy assets, they try to clean up a mess they didn't directly make, but also never truly stopped. It's like a firefighter who arrives after the fire has already taken the house. Now compare that to what a public bank is supposed to be. A true public bank is owned by the state or a community. Its mandate isn't profit, it's service, stability, and long-term development. It lends into infrastructure, small businesses, student loans, affordable housing, boring things, slow things, useful things. And because it isn't chasing quarterly returns, it can survive on thinner margins and longer timelines. That sounds ideal. So why don't we have more of them? because they don't generate the same political donations. They don't inflate asset prices, and they don't make a small group of people extremely rich. Private banks do all three very efficiently. Now here, as the quiet trick most people miss, private banks are legally private, but functionally public. They operate on government licenses. They rely on central bank liquidity. They're insured by the state. They're backstopped in crisis. In other words, they get all the upside of capitalism and all the downside protection of socialism. They've structured the system so that feels normal. Let's talk about 2008 for a moment. Private banks created mountains of risky mortgage debt. They packaged it. They sold it. They leveraged it. Then the system cracked. What happened next wasn't subtle. Government and central banks injected trillions to keep banks alive, not households, not borrowers, not the people losing homes. Banks were rescued first, because if banks fail, the payment system fails, the economy locks up, ATMs stop working, payrolls don't clear. So the public had no real choice. It was either bail out private banks or let the financial system collapse. That's the trap. Once private banks become systemically important, they're no longer truly private. They public utilities with private shareholders, and the incentives don't match the responsibility. Here's the part that never makes headlines. After the bailouts, banks didn't become smaller. They didn't become simpler. They didn't become safer. They became larger, more consolidated, more politically powerful, more confident that they would be rescued again. That's not a conspiracy. That's basic incentive math. If your upside is unlimited and your downside high, is capped by the public, you take bigger risks every time. And that brings us to the quiet contradiction at the heart of modern banking. We claim to live in a free market, but we run the most important part of the economy on a semi-socialized, profit-maximizing credit machine, and we act surprised when inequality grows, bubble, repeat. And crises come back like clockwork. Now it gets even stranger. Because one, you compare what private banks actually do with what public banks could do, the gap starts to look less like a policy choice and more like a design feature. A private bank looks at a loan and asks one question: will this maximize profit for the level of risk? And that's it. Not does this help the economy? Not does this make housing more affordable? Not does this reduce inequality? Just, will this pay? That's why private credit flows into real estate speculation, stock buybacks, and financial engineering. Those sectors generate predictable returns and rising asset prices. It's also why credit avoids small businesses, poor neighborhoods, and long-term infrastructure. Those take time. They're messy. They don't scale neatly. So private banks create oceans of money to bid up existing assets, homes, stocks, commercial property. That makes asset owners richer, it makes new buyers desperate, and it quietly inflates the cost of living without anyone officially calling it inflation. Now look at a public bank, a real one, not a marketing label it can lend into. Projects that don't make sense for private banks, public transit, green energy, low-interest student loans, local manufacturing. It can accept lower profits in exchange for social returns. It can keep interest payments inside the public system instead of extracting them into private balance sheets. In theory, that means cheaper credit, less speculation, and more productive investment. So again, why isn't this the dominant model? Because whoever controls credit controls development. If you decide where new money flows, you decide which cities grow, which industries survive, which communities decline. Private banks currently hold that power, and they use it in ways that look neutral, technical, and boring, but the outcomes are political. Now here's the number that should make you uncomfortable. In most developed economies, over 90% of the money supply is created by private banks, not governments, not central banks. Private institutions decide when most money is born, That means profit-driven firms quietly shape the future structure of the economy. And no one voted for them to have that role. Now let's add a layer of irony. When people talk about government money printing, they usually imagine reckless politicians flooding the economy with cash. In reality, most money expansion happens when private banks ramp up lending during booms. That's when bubbles inflate. That's when leverage spikes. That's when financial fragility builds. Then, when the crash comes, lending collapses, money creation reverses, the economy contracts. And that's when central banks step in with emergency programs and asset purchases. So the public sector gets blamed for inflation and bailouts. The private sector quietly walked away with the gains from the boom. It's like blaming the ambulance for the car crash. Now here's the truly strange part. We already run public banking systems, just not for regular people. Central banks provide unlimited liquidity to commercial banks at near no interest in crisis. That's public credit creation. But households and small businesses don't get that window. They borrow from private banks at high interest with strict terms and brutal penalties for failure. So the cheapest money in the system flows upward. The most expensive money flows downward. That's not an accident. That's architecture. And once you notice that architecture, the difference between private and public banking stops looking like a technical policy debate. It starts looking like a quiet transfer of power, which brings us to the part nobody likes to talk about, because once you see how money is created, who controls it, and who gets rescued when it fails, a very uncomfortable question starts to form. Here's the uncomfortable question. If money is a public utility in practice, why is it run for private profit? Because that's what it is. The payment system is public. Deposit insurance is public. Central bank liquidity is public. Crisis bailouts are public. Only the profits are private. We pretend this is capitalism. It isn't. It's a hybrid system where gains are privatized and losses are socialized, and it's been normalized so completely that questioning it sounds radical. Now let's talk about the quiet long-term cost of that design. When private banks control money creation, they don't just shape markets, they shape politics. Governments become dependent on bond markets. Bond markets are dominated by financial institutions. Those institutions influence interest rates, capital flows, and fiscal space, which means elected governments operate in some financial boundaries set by private credit markets. That's not a conspiracy, that's plumbing. And it leads to a strange outcome. Democratic states technically control fiscal policy, but private banks effectively control monetary expansion. So when a government wants to fund healthcare, housing, or infrastructure, it has to borrow from a system that creates money for profit. It pays interest to access its own monetary sovereignty. That's like renting your own oxygen from a private company. Now, zoom out. Every major financial crisis of the last century follows the same script. Private credit expands, asset prices rise, debt piles up, risk gets hidden, then something breaks. The public steps in, the system resets, the incentives remain, and the cycle starts again. We treat this like a law of nature. It isn't. It's a policy choice that was made decades ago and never seriously revisited. Public banking isn't a fantasy. It already exists in pieces: state development, banks, municipal banks, postal banks, central bank digital reserves. They work quietly, boringly, which is exactly why they don't dominate headlines, because a stable credit system isn't very profitable. And that's the real conflict at the center of modern banking. Stability and profit pull in opposite directions. Private banks optimize for profit. Public banks optimize for outcomes. We merged those two goals in one institution and pretended that wouldn't create tension. It did, and now we live inside that tension with housing bubbles, debt addiction, permanent bailouts, and a generation priced out of assets that were inflated by bank-created money. So when people argue about private versus public banks, they usually frame it as ideology. socialism versus capitalism, government versus markets. That framing misses the point. Real question is much simpler. Who should control the creation of money in a society? Profit-maximizing institutions or democratic ones? Because right now, the answer is mostly private banks, and almost nobody voted for it. The strange thing isn't that the system produces inequality, bubbles, and crisis. The strange thing is that it produces anything else. So the next time you hear someone say, banks just lend out deposits, remember this. They create money. They decide where it flows. They keep the profits, and when it collapses, the public pays. That's not a bug.